Hi, welcome back to Cheryl Trades LEAPS. You can be completely right about a stock and still lose money on your LEAPS. Not because the company is bad, not because your chart was wrong, not because your long-term thesis failed, but because you bought the option when it was too expensive. And the reason it was too expensive usually comes down to one thing: IV rank. Most traders focus only on direction. They ask, will this stock go up? But with options, especially LEAPS, that is not enough. You also have to ask, am I paying the right price for this option? Because in options trading, you are not just trading the stock. You are trading time. You are trading volatility. You are trading expectations. And if you ignore IV rank, you can buy the right stock, choose the right direction, and still end up disappointed. So in this video, we are going to break down exactly what IV rank is, how it affects LEAPS, why high IV can quietly destroy your trade, how to check it, and how to use it as part of a disciplined LEAPS strategy. 1. What is implied volatility? Before we talk about IV rank, we need to understand implied volatility. Implied volatility, or IV, is the market's expectation of how much a stock might move in the future. It does not tell you direction. It does not say the stock will go up. It does not say the stock will go down. It tells you how much movement the options market is pricing in. When implied volatility is high, options become more expensive. When implied volatility is low, options become cheaper. So if a stock has earnings coming up, a major product announcement, legal uncertainty, macro risk, or big news expected, implied volatility often rises because traders expect a larger move. That means option premiums become inflated. And this matters because when you buy a call option, including a LEAP, you are paying for several things. You are paying for intrinsic value if the option is already in the money. You are paying for time value. And you are paying for volatility. That volatility part is where many LEAPS traders get trapped. 2. What is IV rank? Now let's define IV rank. IV rank tells you where the current implied volatility sits compared to its own range over the past year. Usually, it is measured from 0 to 100. If IV rank is near 0, that means current implied volatility is near the lowest level it has been over the past year. If IV rank is near 100, that means current implied volatility is near the highest level it has been over the past year. So IV rank answers a very important question. Are this stock's options cheap or expensive compared to their own history? That last part is important. You are not comparing Apple to Nvidia. You are not comparing Microsoft to Tesla. You are comparing the stock to itself, because every stock has a different normal volatility range. For example, a 40% implied volatility may be high for a slow-moving mega-cap stock, but normal or even low for a high-growth AI stock. That is why looking at IV alone is not enough. IV rank gives you context. 3. IV versus IV rank. Let's make this very simple. IV is the current implied volatility number. IV rank tells you whether that current IV number is high or low compared to the stock's own history. Here is an example. Let's say stock A has current IV of 35%. That number by itself does not tell us enough. If stock A usually trades between 20% and 40% of V, then 35% is relatively high. But if stock A usually trades between 30% and 80% IV, then 35% is relatively low. Same IV number, completely different meaning. That is why IV rank is so important. It gives you context before you buy the option. 4. IV rank range. A simple way to think about IV rank is this. IV rank below 30 usually means options are relatively cheap. This can be a better environment for buying LEAPS because you are not overpaying as much for volatility. IV rank between 30 and 60 is more neutral. It does not automatically mean good or bad. You need to look at the chart, earnings, market conditions, and the specific option contract. IV rank above 60 or 70 usually means options are expensive. This does not mean the stock cannot go higher. It means the option premium already has a lot of expected movement priced in. For LEAPS buyers, this is where risk increases because you may be overpaying for the contract. And when you overpay for an option, the stock has to work harder just for your trade to become profitable. 5. Why IV rank matters so much for LEAPS. Many people think LEAPS are safer because they have more time. And yes, compared to short-term weekly options, LEAPS usually have slower theta decay. Theta decay is the loss of option value from time passing, but LEAPS are still options, and LEAPS are still affected by implied volatility. The Greek that matters here is vega. Vega measures how much an option's price changes when implied volatility changes. Longer-dated options, like LEAPS, often have meaningful vega exposure. That means when implied volatility drops, your LEAP can lose value, even if the stock does not move against you. This is why buying LEAPS during high IV environments can be dangerous. You are paying an inflated premium. Then, if IV falls, the value of your option can drop. This is called volatility contraction. And around earnings, traders often call it IV crush. 6. Example 1. The high IV trap. Let's use a simple example. Imagine a stock is trading at $100. You are bullish long-term, so you buy a LEAP call. The LEAP costs $12, but IV rank is high, around 75. That means options are expensive compared to their own history. Now earnings are coming. The market expects a big move, so option premiums are inflated. Earnings come out. The stock goes from $100 to $105. That is a 5% move higher. You were right about direction. But after earnings, implied volatility drops sharply. Now the uncertainty is gone. The event passed. The premium deflates. So even though the stock went up, your LEAP might barely move. In some cases, it could even lose value. You bought the right direction, but you paid the wrong volatility price. That is the trap. 7. Example 2. The low F4 opportunity. Now let's use the same stock. The stock is still trading at $100. You are still bullish long-term, but this time, IV rank is low, around 20. There is no major earnings event tomorrow. The market is calmer. The option premium is cheaper. Instead of paying $12 for the LEAP, maybe you pay $8. Now the stock goes from $100 to $105. But because you bought when IV rank was low, you were not fighting expensive premium. Your LEAP may rise from $8 to $11 or $12. And if implied volatility expands a little during the move, that can help the option even more. In this case, you win from two things. The stock moved in your direction, and you entered when volatility pricing was more favorable. That is the edge. 8. The key lesson. The key lesson is this. LEAPS do not just need the stock to go up. They need you to enter at the right volatility. Most beginners think, I bought a call, so I just need the stock to rise. But advanced options traders understand. You also need to consider what you paid for that call, because an option can be overpriced. And when an option is overpriced, the stock has to move more just to overcome the premium you paid. This is why IV rank should be part of every LEAPS entry checklist. 9. IV rank around earnings. Earnings are one of the most important times to understand IV rank. Before earnings, implied volatility often rises. Why? Because earnings create uncertainty. The stock can gap up. The stock can gap down. Guidance can surprise investors. Management commentary can change expectations. Because of that uncertainty, options become more expensive before the report. Then after earnings, once the uncertainty is gone, implied volatility often drops. This is why traders say options experience IV crush after earnings. For short-term options, IV crush can be brutal, but even LEAPS can feel the impact, especially if you bought them when IV was elevated. This is why a disciplined LEAPS trader often avoids buying right before earnings, not because the company is bad, not because the stock cannot go up, but because the pricing of the option may be unfavorable. A smarter approach is often, wait for earnings to pass, let IV collapse, watch how the stock reacts, then consider entering after volatility resets. That is professional patience. 10. Example 3. Buying before earnings versus after earnings. Let's say Microsoft is trading at $400 before earnings. You believe in the long-term AI thesis. You want to buy a LEAP. Before earnings, IV rank is 70. The LEAP call costs $45. You buy before earnings. Microsoft reports earnings. The stock rises to $400. That sounds good. But IV drops after the report. Because the premium was inflated before earnings, Your LEAP may only move from $45 to $47. You took earnings risk, but the reward was not strong. Now imagine you waited. Earnings passed. IV rank dropped from 70 to 30. The stock pulled back slightly to $398. Now that same type of leap may cost less because the volatility premium came down. You enter after the event with more clarity and less inflated premium. That does not guarantee profit, but it improves your entry quality. That is the point. You are not trying to predict every earnings move. You are trying to avoid overpaying for uncertainty. 11. IV rank and leaps. Entry timing. For leaps, you want several things to line up. You want a strong long-term thesis. You want the stock near a good technical level. You want enough time until expiration. You want a reasonable delta. And you want IV rank to be favorable. For many leaps traders, an attractive setup might look like this. The stock pulls back to support. The long-term trend is still intact. The company thesis is still strong. Earnings or major news already passed. IV rank has cooled below 30, or near the lower range. That is when the option premium may be more attractive. This is how you stop chasing. This is how you stop buying at the emotional top. And this is how you build a more professional options process. 12. Your A+ LEAPS entry checklist. Here is a simple LEAPS checklist you can use. Number 1. Thesis. Do I understand why I want to own this exposure for the next 12 to 24 months? Number 2. Chart structure. Is the stock near support, a key moving average, or a reasonable pullback zone? Number 3. Trend. Is the larger trend still intact, or am I catching a falling knife? Number 4. Earnings timing. Is earnings coming soon? If yes, do I really want to hold through that event? Number 5. IV rank. Is IV rank low, neutral, or elevated? Number 6. Option structure. Am I choosing a good expiration, reasonable strike, and enough delta? For many LEAPS traders, this means looking for options that are deeper in the money or have stronger delta, because they behave more like the stock and rely less on pure premium expansion. And number 7. Risk management. How much of my account am I risking? Where would my thesis be wrong? Am I buying because it is an A+ setup, or because I am afraid of missing out? That is how IV rank fits into a complete system. 13. High IV rank does not always mean never buy. This is important. High IV rank does not automatically mean the stock is a bad investment. It does not mean the stock cannot go higher. It does not mean you must avoid it forever. It simply means the options are expensive relative to their own history. So if IV rank is high, you have to be more careful. You may decide to wait. You may decide to buy shares instead of leaps. You may decide to use a smaller position. You may decide to wait until after earnings. Or, if you are more advanced, you may consider strategies that benefit from high IV, like selling premium. But for a leaps buyer, high IV rank is usually a warning sign. It tells you, be careful, you may be paying too much. 14. Low VOR rank does not guarantee profit. Now let's be balanced. Low V rank does not guarantee that your leap will make money. A cheap option can always get cheaper. The stock can still go down. The thesis can break. The market can sell off. Low IV rank simply means the volatility pricing is more favorable. It gives you a better starting point. But you still need good stock selection, good timing, good risk management, and patience. IV rank is not a magic signal. It is one tool in your decision-making process. 15. IV rank versus IV percentile. Now you may also hear the term IV percentile. IV rank and IV percentile are related, but they are not exactly the same. IV rank compares current IV to the highest and lowest IV over a certain period, usually 1 year. IV percentile tells you the percentage of days that implied volatility was lower than where it is now. Here is the simple version. IV rank tells you where IV sits inside its range. IV percentile tells you how often IV has been below the current level. Both are useful. For most retail traders, you do not need to overcomplicate it. If either one is showing that volatility is elevated, be careful buying expensive options. If either one is showing that volatility is low, that may be a better environment for buying leaps. 16. How to check IV rank. Now let's talk about how to actually check IV rank. Different platforms show it differently. Some show IV rank directly. Some show IV percentile. Some only show implied volatility, and you may need an indicator or another platform. A few common places to check. Thinkorswim often has option statistics and studies where you can view implied volatility data. Tastytrade is known for showing IV rank clearly because their platform focuses heavily on volatility. Interactive brokers and other advanced platforms may show volatility metrics in their options tools. Bar chart can be useful as a free or low-cost way to check options volatility data. Market Chameleon and Option Samurai also offer options analytics, though some features may require subscriptions. TradingView may have community indicators for IV rank or IV percentile, depending on the ticker and data availability. Webull and Robinhood may show implied volatility on the options chain, but they may not always show a clean IV rank number. In that case, you may need a separate tool. The easiest beginner approach is check the stock's option chain. Look for implied volatility. Check whether the platform provides IV rank or IV percentile. If it does not, use a separate volatility tool to confirm. For your LEAPS process, the exact platform matters less than the habit. Before buying a LEAP, always ask, is volatility low, normal, or elevated? That question alone can save you from many bad entries. 17. What to look for on the options chain. When you open an options chain, look at a few things. First, look at the implied volatility for the expiration you are considering. LEAPS often have different IV than short-term options. Short-term options may have very high IV into earnings, while longer-dated options may be less extreme, but LEAPS can still be affected. Second, compare the IV to historical levels using IV rank or IV percentile. Third, look at the bid-ask spread. Some LEAPS have wide spreads, especially on less liquid stocks. A wide spread means you can lose money immediately, just from entering at a bad price. Fourth, look at volume and open interest. You want enough liquidity so you are not stuck in a contract that is hard to exit. Fifth, look at delta. For LEAPS, many traders prefer higher delta contracts because they move more like the stock and have more intrinsic value. A lower delta LEAP may be cheaper, but it may also rely more on volatility and a larger move in the stock. So IV rank is important, but it is not the only thing. You want the full picture. 18. LEAPS example. With delta and IV rank, let's say a stock is trading at $100. You are looking at two LEAP calls. Contract A has a $70 strike, delta around 0.75, and costs $35. Contract B has a $110 strike, delta around 0.40, and costs $12. If IV rank is high, contract B may be more dangerous than it looks. Why? Because more of its price is extrinsic value. It needs the stock to move strongly. It is more sensitive to volatility changes. If IV drops, that cheaper out-of-the-money LEAP may lose value faster than expected. Contract A is more expensive, but it has more intrinsic value and behaves more like stock. This is why many disciplined LEAPS traders prefer deeper-in-the-money contracts when possible. Not because they are risk-free, but because they reduce dependence on hype, volatility, and perfect timing. 19. How IV rank fits with your strategy. A simple rule for LEAPS could be, when IV rank is low and price is near support, look for opportunity. When IV rank is high and price is extended, be cautious. When earnings are close and IV rank is elevated, consider waiting. When earnings pass and IV collapses, reassess. That does not mean you buy automatically after earnings. It means you wait for the market to show you the real setup. This is where patience becomes an edge. Instead of saying, I need to buy before the move, you say, I need to buy when the risk-reward is favorable. That is a professional mindset. 20. The common beginner mistake. The common beginner mistake is buying LEAPS after a stock already ran up. The chart looks strong. The headlines are positive. Everyone is talking about the stock. The trader feels safe. But by that time, IV rank may already be high. The option premium may already be expensive. The move may already be partially priced in. Then the stock pulls back or consolidates. IV cools. The LEAP loses value. And the trader thinks, but I bought a good company. Yes, but you may have bought the option at the wrong price. That is the difference between stock investing and options trading. With shares, timing matters. With options, timing and pricing both matter. 21. The right stock, wrong option problem. This is one of the biggest lessons in LEAPS. You can choose the right stock, but the wrong option. You can choose the right company, but the wrong entry. You can choose the right thesis, but the wrong volatility environment. That is why LEAPs require more discipline than simply buying shares. A LEAP has an expiration date. A LEAP has time decay. A LEAP has volatility sensitivity. A LEAP has a premium that can expand or contract. So your job is not just to be bullish. Your job is to be bullish at the right price. 22. Simple IV rank. Rules for LEAPs. Here are simple rules you can use. Rule number 1. Avoid buying LEAPs when IV rank is very high unless you have a very strong reason. Rule number 2. Be extra careful buying LEAPs right before earnings. Rule number 3. Look for LEAPs when IV rank is low or cooling down. Rule number 4. Combine IV rank with technical levels. Low IV rank alone is not enough. You still want a good chart setup. Rule number 5. If IV rank is high but you still love the stock, consider shares instead of options. Rule number 6. Do not chase hype. When everyone suddenly loves the stock, options are often already expensive. Rule number 7. The best LEAPS entries often happen when the stock is boring, hated, or quietly pulling back into support while the long-term thesis is still intact. That is where patient traders get paid. 23. Example. Using a hypothetical AI stock. Let's say an AI infrastructure stock is trading at $30. The company has earnings next week. The stock has been running because investors expect strong AI demand. Everyone is talking about it. IV rank is 85. You buy a LEAP call because you think the stock could go to $50 over the next year. The thesis may be right, but your timing may be poor. After earnings, the stock moves from $30 to $32. That is a good move, but IV collapses. Your LEAP does not gain much. Maybe it even drops. Now you feel frustrated. But the issue was not necessarily the thesis. The issue was buying during peak uncertainty. A more disciplined trader might say, I like the company, but IV rank is too high. I will wait until after earnings. Let the volatility reset, then see if price gives me a better entry. That is how IV rank protects you from emotional buying. 24. Example. Using a mega cap stock. Now imagine a mega cap stock like Microsoft. The stock is in a long-term uptrend. You want to leap because you believe in cloud, AI, and enterprise growth. The stock pulls back to a key support level after earnings. IV rank drops to 25. The chart stabilizes. The thesis is intact. This may be a much cleaner environment to consider a leap. Why? Because you are not buying into peak hype. You are not buying right before a binary event. You are not overpaying as much for volatility. You are combining long-term thesis, technical support, lower volatility pricing, and better timing. That is the kind of setup LEAPS traders should be waiting for. 25. What IV rank cannot tell you. IV rank is powerful, but it cannot tell you everything. It cannot tell you whether the company is good. It cannot tell you whether the stock will go up. It cannot tell you whether earnings will beat. It cannot protect you from bad position sizing. It cannot replace risk management. So never use IV rank alone. Use it as a filter. It helps you decide whether the option premium is attractive or dangerous, but the trade still needs a thesis. The chart still matters. The market environment still matters. And your risk still matters. 26. My personal LEAPS framework. If I were building a disciplined LEAPS framework, I would think of it like this. First, find the company. Is this a company I would want exposure to for the next year or two? Second, check the chart. Is price near support, or am I chasing? Third, check the calendar. Is earnings coming soon? Is there CPI, Fed, or major macro risk this week? Fourth, check IV rank. Are options cheap, normal, or expensive compared to history? Fifth, check the contract. Is the expiration far enough out? Is the delta strong enough? Is the bid-ask spread reasonable? Is open interest acceptable? Sixth, size the position. Even a good setup can fail. So the position must be small enough that you can think clearly. That is how IV rank becomes part of a complete professional process. 27. One sentence to remember. If you remember one sentence from this video, remember this. You are not just trading direction. You are trading direction, time, and volatility. That is why IV rank matters. It tells you whether volatility is helping you or working against you. When IV rank is low, you may be buying options when they are less expensive. When IV rank is high, you may be buying options when expectations are already inflated. And in LEAPS trading, that difference can have a major impact on your results. To wrap it up, most traders focus on being right, but professional traders focus on something deeper. They focus on price. They focus on risk. They focus on timing. They understand that even a great stock can be a bad options trade if the premium is too expensive. That is why IV rank matters. It helps you avoid overpaying. It helps you stay patient. It helps you wait for better entries. And it helps you protect your capital from invisible volatility risk. So before you buy your next leap, do not just ask, "Do I think this stock will go up?" Ask, "Is this option priced fairly? Is IV rank low or high? Am I buying opportunity or am I buying hype?" Because in options trading, being right is not enough. You have to be right at the right price. If you want to learn more about LEAPS, option strategy, risk management, and how to trade with discipline instead of emotion, make sure to subscribe. This channel is about building a professional mindset, one trade at a time. And remember, the market does not reward activity. It rewards discipline. Thank you for watching and see you in the next video.